Welcome back to Wealth-ology. For today's video, we will be going to talk about how to invest and prepare for the next market crash. Let's get started. Opportunity in low-growth stocks. According to Grantham, low-growth equities and value stocks offer the best investment opportunities in the current market. That's what you typically refer to them as the technology, the AI. The so-called 10 times equities are expensive but have significant growth. He believes that stable, low-growth stocks are the ones that present better bargains. Grantham said, "I suspect selling everything would work out just fine. However, having said that there are major discrepancies as there were in 2000s between the US tech, which is overpriced, and everything else, so low growth stocks value are about as cheap relative to the high growth stocks as they ever get. So they will not have the same pain. But they are still at risk to some degree, I suspect." What he's saying is when the crash comes, the ones that are going to get whipped out the most will be the high growth stocks, the so-called 10 times ones that have just shot up in price, the likes of Tesla, NIO, Zomedica, and etc. Because these are the ones that sell at high prices compared to what they bring in terms of profit. When consumer and investor confidence decreases, these stocks that have gone up so high have the most to lose. So, value stocks, that's where Grantham sees opportunities in today's market. Opportunity in emerging markets. Grantham also sees an opportunity in emerging markets. The good news, he claimed, is that other countries have not had the same protracted bull market and excessive pricing that we have, which is obviously a heaven devoid of opportunities. Because when you enter the emerging markets, you will find that they are not at all expensive. In fact, as compared to the SP, they are about as inexpensive as they have ever been. They have been this inexpensive 2 or 3 times, and each time it had been a great success. Therefore, you can invest in emerging markets and consider the low growth equities found there, which is the junction of two concepts. Moreover, they are affordably priced. There should be a rare opportunity for you to earn a respectable 2 to 10 year return. So it's intriguing that Grantham observe low long-term returns in more developed markets, particularly the USA. However, he believes that the emerging markets have the most promise. For those who are unaware, examples of developing markets include Mexico, Russia, Pakistan, Saudi Arabia, China, and Brazil. These are considered to be emerging economies. They're not yet full developed, but they are in the business development and growth stage. Mature markets overvalued. The interesting thing about these markets is that, despite their robust growth, investors frequently avoid them. Everyone wants to invest in places like the USA, Canada, or the UK because they are well established. But the problem with that is that it drives up prices to exorbitant levels, according to the Grantham's analysis of the US market. Investing in US growth equities won't earn you a respectable return over a decade or two. There is an unspoken rule in the market that the higher you bid up an asset's price, the smaller your long-term return will be. Let's imagine you pay $100 for a share of stock, and we'll say that share of stock pays a $5 dividend annually. That clearly represents a return of 5%. Suppose you pay $200 for the exact identical shares at this point. Now, the annual return is merely 2.5%. Every season, investors are aware that their return is lower because they paid a higher price. And this is one of the reasons that those rising markets provide so many opportunities due to the low number of investors looking there. Consequently, insufficient stock demand leads to low stock prices and higher potential returns. Opportunity in green sector. The green sector is another area of this market where Grantham sees opportunities. He is saying that the contemporary economy is controlled by fuel, gas, smoke, and dirty energy. But that will change in 10, 15, or 20 years because the world needs to become more sustainable. There is a lot of promise in owning the stocks that will contribute to this transition now. The stocks that rely on unsustainable energy and are trapped in the past are unlikely to do as well. Grantham's thoughts on gold. He has previously purchased gold and doesn't mind using it as a hedge and investment. He claimed that gold has through the unusual 12,000-year test, which it has passed fairly successfully, and that gold also possesses some backup capabilities. Because it doesn't tarnish, it is special in that everything that has ever been been made of gold is still in existence. It has two major advantages over Bitcoin while not paying a dividend, which, incidentally, Grantham is not at all fun of, since it technologically provides so much more value than conventional money. Its market capitalization is currently substantially lower than that of gold. Therefore, one can allocate a tiny percentage of their portfolio to Bitcoin. Grantham, who strongly favors gold, obviously disagrees. The Fed is running things for investors. The one thing that we definitely do agree on is our dislike towards the Fed and its market manipulation. Grantham said, by pushing up assets prices, you do two things. You make it difficult to impossible for people to get into the game. The purchase of a house is too expensive. The purchase of anything in stocks is much higher per dividend or units than what it was. So that's brutal. Secondly, the compounding of wealth is reduced. If you have a 6% yield on your assets, by reinvesting that, you can double your money in 12 years. If you turn it into the 3% yield by doubling your price, you're worth more on paper. But in real life, you can only eat the dividends. And now that 3% a year and you double your money in 24 hours, so in 48 hours, you're down to a quarter of what you would have been. And the gap becomes ruinously wide. In other words, the higher the asset price, the lower the rate at which you can compound wealth. And if you're not in the game and you're a beginner, you can have great difficulty ever getting into the game. By definition, it means that the rich can get richer as you price down the yield and mark up asset prices, and the poor get squeezed. Investors should be extremely cautious when playing the game. The Fed is playing because it makes you feel fantastic, that your stocks are rising, but it's all manufactured. Which seems that if you want to purchase stocks right now, they are incredibly costly compared to what they ought to be. Personally, I think this is going to lead to a lot of people getting burned. Equities will eventually experience what happens to balloons when you can't keep blowing air into it forever. This is why it's crucial that we continue to be ready right away. According to Grantham, emerging market low growth value stock and green equities are where the possibilities are. Which aspect of this subject have you found to be very useful? Please let me know in the comments section below. And if you like this video, please give it a thumbs up, turn on the notification bell, and subscribe to our channel for more. Thank you for taking the time to watch. Stay tuned for our next video.